Well, it's a very good morning from him, and of course it's a very good morning from me. I hope you are. Welcome to my mortgage live stream. I'm Paul Archer, but you know that by now, I imagine. Welcome to our regular weekly mortgage and financial update for you if you're doing CPD or learning CMAP or whatever you're doing, ready to help you in the industry. Got the budget, of course, coming up, and I read this morning that half of first-time buyers are waiting for the budget before they take their next step. I don't know why, but everybody's worried that the budget's going to devastate the whole industry and there's going to be locust infestations and all sorts of things. But that's all about sentiment, isn't it? And our market boils down to how we feel about things. Of course, first-time buyers are going to have a good time next year, and we're going to come on to that why. The market is changing a lot, and I want to explain to you this morning where the change is occurring. I'm sure you've read about it unless you've been living under a rock. We went for a walk this weekend, long walk on Saturday, about 10 miles over at Painswick, and the weather's changing. It's like middle of November now. What is it, 17th of November? We've had that mild period for a while now. Now it's getting colder and the leaves have gone. It's getting wetter. So the weather's changing and you can feel the change in the air, can't you? Likewise, the same with financial services and the mortgage sector. Let's come on to that now. Another little tip for you about expanding yourself, stepping into the uncomfortable zone, doing better than you're doing. With all these changes coming into the sector, maybe time is for you to step into maybe an uncomfortable zone. So we've got that coming up later on for you. You can't wait, can you? Anyway, let's get into our topic then today, which is all about this mortgage change. So the first one for you is the mortgage or the modified affordability assessment. So let's pop over to my whiteboard over here for that one, shall we? The modified affordability assessment. What is this? Where did this all come from? And where does it lead into the mortgage review that's going on as well? Well, as you can appreciate, of course, the regulator has wanted to help the government with their long-term aim of expanding the economy. And what they're trying to do now is to remove some of the restrictions that we had from the mortgage market review. Now, if anyone knows their history, the mortgage market review, which was, of course, 2014, which was 11 years ago now, tightened up the mortgage lending massively post-pandemic, or post the financial crash, I should say, not pandemic. Post the crash, we wanted to tighten up what people could borrow, and it made it very, very strict. So the aim of this new modified affordability assessment is to remove the strict criteria that was put into place then. And it was very strict, and it's affected how much people can borrow, maximum lending, all sorts of things enormously in the marketplace that we're in. And it's meant that lots and lots of first-time buyers can't buy the properties they want to buy. So what's the regulator doing? Well, the first thing they're doing is they're going to make it easier to remortgage. That's the first one, or what we call in the business the remos. There you go, the remortgages, where somebody has a fixed rate, maybe it's coming to an end, or they just want to move to another lender. If they want to move to another lender and the new deal is better for them, it's a better interest rate, etc., a better deal all round, then they're allowed to move to that or remortgage that new lender with very little extra requirements. It's going to make it a lot easier. And there are conditions, of course, but the whole point is it allows them to borrow more to a certain degree. It allows them to borrow a lot easier, but we'll come on to the conditions for you in a moment. So what's happening? Well, first of all, you've got this remortgage. The first thing they're going to do then is to get rid of stress testing. So stress testing has pretty much gone now. Most lenders started getting rid of this last year. The stress testing has now gone. Now, the whole point about stress testing was that it made lenders check to see if customers could borrow the same amount of money at a high interest rate, to stress them, if you like, stress test them. But what it meant in effect was that this strict criteria was put in, and you couldn't lend them as much as they wanted. So that's going to go as well. What they're also bringing in is a simplified, and this is the real key one for you, a simplified income verification or income corroboration, call it what you like, which means they're going to make it a lot easier for people to have a certain income and borrow a whole lot more. They're going to verify this as well. And you've probably already seen this happening. It happened during the summer. And a number of lenders have really taken this on and are really moving forward. And what's happening from about July onwards, or July 2025 onwards this year, a number of lenders are now starting to lend large amounts of money. So let's show you a couple of clips from the press. Let's just put this one up for you. This one's TSB. Eases stress test to allow up to £30,000 of extra borrowing. And this was July 25. TSB, big lender, and they got rid of their mortgage stress test for consumers, which immediately allow people to borrow up to £30,000 more, which is great if you're buying your first place. Here I've got Santander, again another big lender to consumers. Not particularly specialist lenders. These are just run-of-the-mill, vanilla high street banks, if you like. And as you can see probably from the detail here, if I can just zoom in a little bit to sort of share with you what we've got. Let's go back a bit. There we go. Let's just share with you what's going on here. There we are. So they announced the changes. Less than £45,000. This is the customers earning, so it's salary. Less than 45 can access 4.5 times their income. If they're earning between 45 and 100, they can now access 5 times their income, up to including 90% and 4.45 or 95% loan to value. If they're earning a lot more, they can access 5.5 times their income at all LTV levels, including 90% of 4.5 or 95%. So look at that. Customers remortgaging to Santander can now also access 5.5 times their income. Santander's a big bank. It's a high street bank. They do tons of lending. And what they've done, as you can appreciate there, is they've allowed people to borrow so much more money than ever before. And that's making a real big difference to the marketplace. And there's one more for you. This was from Nationwide. You've probably heard of these guys. Of course, you have Big Bank or Building Society. They're increasing their first time after regulator relaxes the high loan to income rules. Look at that. They've got this helping hand mortgage 6 times income. Look at that. Brilliant. You've got lots more loan to income lending. Follow moves by the Prudential Regulation Authority, of course. Sole applicants helping hand now need 30,000 income, down 5. Joint applicants 50 grand. So these people just first time buyers, aren't they? And helping loads more people to borrow a massive amount more. Now, of course, you can take the opposite view, that these people are borrowing more than they can afford, and therefore they're going to get into arrears and get repossessed. You can have that view if you want, but these are good lenders. I mean, I've worked for the Nationwide for years, and as well on TSB, I work for Lloyd's. They're good lenders. They've got good rules and regulations. They make sure people can borrow what they can afford, and often these first-time buyers can, because they've been renting privately. So yeah, you're looking at relaxing the loan-to-income rules is really where they're coming from. So they can have many more people borrowing large income criteria loans, and six times somebody's salary is not unheard of as well. Now this remortgage situation they brought in, the ability to remortgage, was designed really for people who, when they took out their mortgage in the first place, they were granted a mortgage which wouldn't be allowed now. So if they were to remortgage, they wouldn't get it from anybody else. But if they found somebody that's a much better interest rate, they can do so. Now there are some conditions. No more borrowing is the first condition. These are often called mortgage prisoners. Is the criteria. That's number 1. Number 2 is their account has to be up to date, of course. Put a little smiley in there for you. They can't be in arrears or anything like that. It is remortgage only, so remo only is the other one, which is key, of course. And the new deal that they're getting must be a better deal. It must be more more affordable, maybe a lower percentage interest rate. So it must be a better deal, and they're able therefore to convert over to these with a much easier criteria on borrowing. So it's trying to help all these mortgage prisoners who years ago, before the financial crash, were given mortgages, because back then they gave anybody with a pulse, didn't they, a mortgage, and then they can't get a loan from anywhere else because nobody else would accept them because their income's difficult or whatever. So it allows them to go there and obtain a better mortgage deal for them to help them, and I think that's a really good move. But the big one though is this stress testing and these loan to income verification changes and affordability. I think it's a great thing, I really do. So first time buyers can borrow large amounts of money and get that big mortgage that we all used to do back in the 80s and 90s, which people forget about that. So that's the first change. Let's now go on to our second change, shall we? And what we'll do now is we'll pop over to another whiteboard, pop over here. This one's a little bit more contentious, and you've probably read about this and have an opinion. Quite sure you do as well. So I know it'd be interesting to know what your opinion might be when it comes to it as well. So we'll take a look at that, shall we? Okay, mortgage rule review is what it's known as. And this is a key one, a real key one, this one. What's happening is that we have this government desire to improve the economy. They definitely want to do that. And a little while ago, Rachel said to all the regulators across the whole piece, she said, look, regulators, make it easier, make the economy grow. You know, stop stifling people with red tape and all those things. So she's got this 5-year strategy, hoping that she's going to be in power for a few more years after that. And it's to grow the economy. So she said to all the regulators, look, cut back red tape, get rid of it all. We want to grow the economy. Let's get things moving. Now, the FCA, headed by Nitty, they took to this, and they've been really good. I think he has political ambitions, maybe, but the fact is, they've taken to this, and they've now got this sort of phase going on. They've got this long-term phase now to help with the mortgage route. In other words, to expand the economy. So what have they done? Well, first of all, in May, let's put a timeline in there for you. In May 25, they decided to consult the industry, to tell the industry what they're thinking of doing and getting the industry's opinion. And the industry obviously has done it, given their opinion, haven't they? Now, in July 25, so this year, of course, they've introduced their first phase 1, if you like. It's probably the way of putting it. Now, in phase 1, they've introduced some rules that they're going to do. And the first one they've done is they've removed the trigger rules, which, again, not happening yet, it's going to happen, but this is what they're going to do now. Now, when I say removing the trigger rules, they're going to relax them. Relax the rules around advice. And that's the thing. Now, what do we mean by this one? Well, up until now, as soon as a customer talks to a lender or somebody who's involved in the mortgage business and starts to have a discussion with the lender, so as soon as there's been a discussion, and that can be online, via a chat box or on the phone or face-to-face or whatever it is, as soon as they start to have a discussion, that triggers the need for advice. In other words, the customer must receive advice. So if you phone up a bank and say, look, I'd like to talk to somebody about a mortgage, get some ideas together, get a few options. And as soon as you mention that, they say, right, you need to see a mortgage advisor. You need advice on this. We have to, under the regulations, give you advice. And, you don't have to accept the advice, but we want to give you advice. And that's what's called the trigger rule. Now, that's going to be relaxed. So what does that mean? Well, that's actually massive, if you think about it. Removing this trigger, it's going to be massive. So what's going to happen is that, this young first-time buyer who's read in the paper that he can borrow, or she can borrow 6 times their income, they think, hold on, we can get a mortgage. Okay, let's look at our options. And where are young people going to go to look at their options? Obviously, they're going to go on their phones. And on their phones, they're going to access, influencers, people, information, whatever it is. Because that's where they get their information from. You can't argue with that, because it's the way that the world rolls. And as they start to listen to influencers and people and all that kind of stuff, they'll probably get onto a few lenders' websites or apps, I should say. And they'll probably start talking via chat box or some kind of text-based thing. And they'll come across this field, this app, and it'll say, hi, you interested in a mortgage? Yeah, oh, yes, please. Certainly looking at our mortgage that we can get so we can buy a house. Well, that's great. And what they'll then say is they'll say to the borrower, this consumer, okay, well, as you know, you could get some advice. Do you want advice? You have an appointment to talk to somebody, and that's great if you do. But if you just want to think about your options, some ideas that you've got, which is, a great thing to think about, then you probably don't need to worry too much about advice. So why don't we therefore take a look at that, and why don't we just let you look at your options? And the customer says, yes please, I'd like to look at my options. Look at options, which is just a phrase they use, isn't it? So the lender says, okay, well, if you don't want advice, just click on this button to say that you don't want advice. So click on this little button, and because you're clicking on the button, you're not going to get advice. So you're not going to get the protections from the regulator, etc., etc. But if you're okay with that, click on that button, and we can go ahead and give you some options. So the customer thinks, well, okay, I'll just click on that. Nobody reads terms and conditions, do they? And this customer, therefore, will then start to get a lot more options from the lender. And what's exciting about that, if you're a consumer, of course, is you don't then have to make an appointment to see somebody and spend an hour with that person going through a fact find, identified needs, all those things. You can look at what's available to you maybe from that lender. So they'll give you videos to watch, information to give. They'll probably sign up the likes of Martin Lewis or one of the other famous people to do videos to explain how a repayment mortgage works and how an interest-only mortgage works. They'll get all sorts of people to do that, and it'll be great. And this first-time buyer will get all the options they need. They'll then make their decision and they'll take out that mortgage. That is revolutionary, as you can probably appreciate. So you need to be aware of that. You need to be aware that's coming. It's going to happen, and it will affect the market enormously. How's it going to affect it? Well, nobody knows yet, do they? But you can kind of put two and two together. The banks are going to run with this. They've obviously got to be careful because they have a broker community to look after. They do lend a lot of their money via brokers, but they can start doing their apps, getting some AI involved in. Giving, as long as people say, no, I don't want advice, they can start giving people information and they can do their research and make their decision based upon that. Obviously for complicated stuff, complex incomes and people's situations, they'll go and talk to somebody, because you will. But for the vast majority of straightforward mortgages, this is what will happen. And the banks will use this. They've got the technology to do it now. Of course they have. There we are. Just lay the information down to you and let the furor start. Okay, there's more to come. There's much more to come. So let's just give you a few ideas about the future, which is very exciting in the world. The first thing is the FCA are going to look at the later life marketplace. Now that is very exciting because there's a lot of silos there. Advisors can do one bit of advice but not the other bit of advice. Maybe they'll make it so that the later life brethren don't need advice themselves. They can look at the options. It is a dangerous area, it's vulnerable customers, all those things. But they're going to look at that area to make it easier and simpler for people to take out advice or loans, etc. in the later life marketplace. They're going to look at interest-only mortgages again. Interest-only mortgages. They're going to look at how people can take those out. A lot easier than they currently do. Now you have to sort of prove that you've got ways of paying it back, but that'll be eased off dramatically, because interest-only mortgages are right for some people, and why can't they be available to people if they need them as well? There's going to be lots more going on with AI tools as well. The regulator's going to be making it a lot easier for lenders to use AI tools down here on the phone, to help people with their options and things. And they're generally going to take a look at lending rules as well, which of course affects the banks and the lenders, building societies. So a lot of change coming down over the next few years. The FCA's committed to this. They're rolling with this one now. And I think in a year or so's time, not only will people be able to borrow a whole lot more than they currently do now, they'll be able to do it a lot easier and simpler. And dare I say it, and many people won't need advice for a fairly straightforward mortgage. They'll be able to do it themselves. And there are a lot of people like that who will, and you have to deal with that. You have to cope with that. You have to cope with the change that's going to bring in, and we can talk about that another time as well. So that's just what's coming down then with the mortgage rule review. Wanted to keep you up to date with that one. Bye. There you go. Well, it's not really a laughing matter effectively, because you know, the industry has initially come back and said, no, people have got to have advice. Everyone needs advice. You know, of course they do. Advice is so important to people. And it is, don't get me wrong. I built my career around financial advice and mortgage advice. But there are some people that don't. And that's the thing about these apps, and these AI will be able to service these people and give them what they want. But we can come back to it another time. Let's go on to our last topic, shall we? Let's step into the uncomfortable zone, shall we? Now, why stepping into discomfort is the fastest route to growth? Have you ever stepped forward and realised there's no turning back? That's where growth begins. It's one way to gain some momentum and motivation to move forward rather than backwards. Last weekend, my son Lewis and I went for a 9-mile hike around the hills in Leckhampton. Our return home was pretty uninspiring, merely going downhill into Cheltenham to the welcoming arms of the Wheatsheaf pub, until we missed our turning in the woods and found ourselves descending almost vertically. It was the site of the old lime quarry. The path looked pretty easy to start with, but took an alarming downward trajectory, too late for us to turn back. We'd reached that point when reversing is more difficult than moving ahead. So we continued, holding on to branches, sliding on our backsides, thrashing through the woods until we finally made it down safely. Of course we did. Of course we arrived safely. A little battle hardened and a bit bruised as well. Now, last year I was asked by my speaking association to take over the virtual region all on my own. The idea sent shivers through me. I was unaware of the amount of work involved, let alone that I had the time, but I knew it would be good for me, so I took the role on. Now, the first month was scary, to say the least, as I had to juggle running a busy training business alongside mastering the group's operations. I can't say I enjoyed the start, the unknown, the worry, the occasional sleepless nights, but I couldn't turn back, so I continued unabated. Just like that steep descent, taking on the speaking association role was daunting, but moving forward was the only option. I came through, and better for my experience. So what's your next uncomfortable big step? Take it today, because growth doesn't wait for you. I'd have preferred, of course, an easier path, but Lewis and I reached the pub unscathed with a story worth telling. There you go, there you go. True story, makes you think, doesn't it? Okay, good. 17th of November today, not far from Christmas. What are we, 5 weeks away, 4 weeks away to Christmas? Budget coming up, which will, I think, be good news to a certain degree for certain types of people. The mortgage sector, I think it'll be good news for the new year. So we could look to things really taking off with all this new affordability rules and maximum loans and stuff like that. I think it's a really good sort of stage that we're in, really, when it comes to it. So as always, keep in touch with me. I've got a CPD program for you as always. So let's just put the blurb up there on the screen for you. And there's the QR code if you want to grab that and start getting into our CPD program. Let's pop across there so you can see that as well. Get onto our database if you can do. We've got lots of things going on as well, particularly next year. Very exciting times for everybody. I hope you enjoyed the live stream. I did, as always. And I'll see you all guys next Monday for another live stream. See you soon. Bye.